Hello, good evening.
Yes, good evening.
Yes, we're so excited to have you with us today for our seminar.
Yes, but wait a minute. We have to share with our viewers. We have been doing all kinds of
Yes.
back behind the scenes fix it. For some reason, our mic would not go on.
And our camera, but we fixed it, thank God.
Yes,
So we're here with you.
yes,
Couple of minutes late, but hey, better late than never. And we're so excited
yes.
to be here with you for loan factors, types, and programs. Of course, I'm Kimberly Turner.
And I'm Denise Turner.
And you know, we
We
are
are
the
the
Turner
Turner
team.
team.
And we're here today with our special guest, none
Yes.
other than Roderick Nash of Guild Mortgage. He is
The senior loan officer.
Yes, and we're just elated for the information that he's going to share. We're going to talk through all of the factors that can affect your pre approval after you've been pre approved so that you know ahead of time what to look out for and how to protect your pre approval amount.
Yes.
We're also going to talk about
the various types of loan programs and
the various type of loans.
and the various type of loans, of course.
Yes, so FHA, VA, and conventional. And we'll talk about down payment programs and closing cost programs. So you want to stay tuned until you get all the information you need. So listen, if you think that's something that you or your friends or family may be interested in, be sure to like and follow our Facebook page, as well as subscribe on our YouTube channel to make sure that they too can get this great information. And you know, who are we?
We are the Turner team.
And we are a mother-daughter team. And we're located here in the state of Missouri, and we work throughout the country with our top realtor partners, specializing in residential and commercial real estate, working with buyers, sellers, and investors.
Yes,
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 yes.
yes.
And so we're excited to be here today. So, without further ado, since it took a little bit of time to jump on tonight, we want to introduce our special guest with Guild Mortgage, Roderick Nash. Please welcome him to our show this evening. Hey,
Hi, how you doing, everyone? Hey,
We're so happy to have you here this evening.
very glad to be here.
Yes,
Very glad to be
yes.
here.
Hey, we always like to give our special guests the opportunity to introduce yourself because who could introduce you better
Than yourself.
Well, thank you very much, ladies. As they mentioned, my name is Roderick Nash. I'm a senior loan officer with Guild Mortgage. I also am the CEO of Rockgate Financial Services, which is a commercial company. So I cover both residential and commercial lending. Tonight we'll be discussing residential lending and basically the different things that you guys as a potential buyer will want to know to make sure that you stay in compliance with your loan approval. I've been in the industry about 25 years now. I know just about every type of loan program out there, conventional, FHA, VA, USDA, commercial, SBA, you name it. I've got a good education on all of it. My motto is if I don't get you across the finish line, then I've not done my job right. And so in order for me to get you across the finish line, I need to make sure I educate my buyers properly so that that not only that we get across that, but we get across the finish line as smoothly as possible. But that's basically my credentials. I've been doing this a long time, and I'm looking forward to helping with you.
Yes, excellent. So now you know a little bit about Rod, but as you stay tuned in tonight, you will learn a lot more about him, but especially about the information and knowledge, the expertise that Roderick has. And
Yes. And he's a very well trusted loan officer.
yes,
So that's important. Expertise, knowledge, being trusted by your clients, and just the fact that he is dedicated
that's right.
to the work that he does. Because, like he says, his job is to get you across the finish line.
That's right. And if you are wanting to get in contact with Roderick, of course, what you do is you go ahead and scan the QR code on the screen. And make sure that you register for tonight's seminar as well, even if you're watching on the replay, because this way we can reach out to you as well as you can schedule a call with us and be able to talk with the Turner team, as well as we will connect you to Roderick Nash so that he can make sure you're getting your home loan so you can purchase that new home in 2023. All
All
right.
right.
Excellent. So,
Right
Roger, let's jump right in. We're
right
excited
on
about
in.
conversation, honey. So, let's talk about pre-approvals
Sure,
and debt to income ratio.
sure.
Those are two terminologies that maybe people have heard of but don't really know too much about. And in our previous seminars and webinars, we've talked in detail about what is a pre-approval as well as what is your debt to income ratio. But give just a small synopsis, a general statement of what each of those are.
Okay, sure, no problem at all. I'm glad to do it, Kim. First of all, it depends on the type of loan that you're doing. So if you're doing like a conventional loan, which is one of the more common loans, a conventional loan, you've got a debt to income ratio that's going to put you roughly around 33 to 43%. 33 is what they call your front end ratio. 43% is what they call your back end ratio. Your front end ratio is all your housing expenses divided by your gross income. Your back end ratio is going to be your housing expenses and your revolving installment debt combined divided by your gross income. And so both programs, basically, they have a formula that they allow or want people to kind of abide by to give it more, or should I say, to help to apply it or be in compliance to what they want you to have to be able to get a loan approval through an automated system.
Yes, excellent, excellent. And so we wanted to give that overview just so that our viewers know for this conversation what we're talking about
Mhm.
next, right? And so if you don't know too much else about pre approvals or debt to income ratio, make sure that you go and watch our other videos that we
Mhm.
discuss it in detail. But Rod, tell us about the three factors that can affect your debt to income ratio, which then could affect your pre approval once you've already been pre approved.
Yeah, sure, no problem. One of the factors, of course, is your credit. Making sure you keep your credit utilization to as low as possible. Like I said, you have a front end ratio and a back end ratio, and so when someone's already pre-approved, we want to make sure that they don't exceed that by the time we go to closing. So, as I mentioned before, you've got a FHA ratio of 33 to say 50% on the back end. So if you've got the credit card usage and you're blowing up your credit cards while we're getting you to the finish line, then there is a chance that you could not get qualified for that loan by the time we get to closing. So you want to make sure you keep your credit card usage to a minimal. You also have what they call your escrows, your taxes, and your insurance. That can affect your front end and back end ratio also. So you want to make sure that when you do look for a property, that you have your loan officer review the taxes, the insurance, the homeowners association, and make sure that all that's, and your mortgage insurance if you have FHA or conventional, to make sure that all fits within your criteria to keep you in compliance with your loan. So that's really your main thing there.
Yes, yes. And so let's dive into those factors, right?
Okay.
So we know that yes, credit is one. You want to make sure you maintain your credit. You want to make sure that you maintain your savings, right? Those are very important that you do that.
More
But this
importantly, though, is make sure you stay on top of your payments. Don't
there you
forget
go.
your
Yeah.
payments while you're waiting, to find that house, because see,
There
people
you
have a
go.
habit of forgetting to make a payment on the bill, and then that can turn out to negate them getting that home then.
Exactly. And
Yes.
so when you maintain those payments,
Payments, and make your payments early.
that's right.
Don't
Exactly.
wait to the last minute to make those
Mhm.
payments. Make sure they are early, or definitely they
On
must be on
time.
time.
That's right.
And
And so let's talk about some factors that maybe our viewers, potential buyers have not thought of. They're not aware that homeowners insurance,
mhm,
right? Property taxes, HOA, but really more so condo fees for the
mhm,
home that you're going to buy. We call everything a home, whether it's a single family, right? Villa,
Mhm.
townhome, condo.
Mhm.
So the home you're going to buy, it could affect your overall pre-approval. So let's dive
mhm.
in one at a time. Start with homeowners insurance. What is homeowners insurance and how can that affect you with your pre-approval?
So your homeowner's insurance is hazard insurance, also known as that. It protects you and the lender in case there's an accident or fire or something that breaks out and the house is damaged. So that's something that's mandatory that they require that you do have on the home. And if you don't stay on top of it, they can force the insurance on you and actually charge you quite a bit more than what you would actually get as a client getting your own insurance. The homeowner's insurance can fluctuate also drastically in regards to the monthly payments. So you definitely want to shop around for your homeowner's insurance and try to get the best for your buck. But if you have too high of a payment on your monthly mortgage insurance, that can actually get you to not be approved on a property. So you want to make sure that you do shop and you get a good price on that. Same thing applies to your taxes. So a lot of times we don't know about the real estate taxes on how much it's going to be. Well, your agent's going to be able to find that out as you're looking at your properties, and they can call you up or call me up and say, hey, Rod, we've got a property with this type of taxes on it. I've worked with enough insurance agents to be able to kind of ballpark what the insurance is going to be on that and be able to make sure that you stay within the criteria for your debt to income ratios to keep you approved.
Yeah,
Yes.
so that means like the insurance usually you pay every month.
Yes.
So that each payment is going to be part of your debt,
Mhm.
and then your property taxes that's paid. Well, it's paid at the end of the year, but some loans you have to pay on it each month,
And that is
and
included then
that's
in your
that's
debt.
that's included
Exactly.
in your debt. And then the condo fees, you have to pay them every month, and that's included in your debt. And a lot of people don't think about that.
No, no. And go ahead.
Well, I was going to say, in regards to all those different factors, they matter so much in your approval and making sure you've got the right agent looking out for you and having a good idea of where your price range is, is very important. When I, as a loan officer, say, okay, I've got you pre-approved. I've looked over your taxes, your insurance, or excuse me, your income. I looked over your assets. I looked over your credit. I'm going to say, okay, this is where you're going to be maxed at. And then you guys go from there and say, okay, well, Ryder approved up to say $500,000. Well, you can go 500,000 on down, but don't want to go over that. You go over that, and then we're going to have a debt to income ratio problem.
That's
Yeah.
right. That's right. And so it's the responsibility of us, your realtors, to make sure that you are being accountable to stay within your pre-approval amount,
Yes.
right? And so that's what we do. So before we go and see a home, your first step is your pre-approval, right? So we send you to our lender and they're able, right? Rod is able to then pre-approve you for a certain amount. Now, when you get pre-approved, we're going to make sure that Rod knows, are you buying what type of home, right? Is it a
Mhm.
condo, townhome, or villa where you will likely have a condo fee if there's a condo association? And if so, what is that allocated threshold amount, right? Is it $250? Is it $300,
Per
right?
month.
Is it 300,
Yes.
is it 100 and something a month that you can allocate towards your condo fee? And when we know that, then when we're looking at the condos, before we even step foot in the condo, part of our due diligence is doing that research for you to make sure that the condo fee is within the range that you as a buyer can purchase based upon your debt to income ratio.
Yes, because we hate to take you out to a beautiful condo and you find out that the condo fees are really extravagant and you can't afford it.
That's
So
right.
it's always good to, as we say, to know beforehand so we don't go out there and you fall in love with a condo that you really can't afford.
That's right. And so we make sure you're falling in love with the right one
Yes,
that's in your budget,
at
right?
the right price,
At
the
the
right
right
one at the
price.
right
That's
price.
right. And then just to also summarize property taxes, right? So when you're thinking about property taxes, not too many people think about that, but we won't know what your upcoming property taxes are, right, in the future, but we know what it was in the past. And so we looked that up for you. And Rod, your lender is going to make sure that he's already calculated a general amount that you can put towards taxes every month. And so when we're looking at that, and when we send the property to Rod, he can verify further that you're within your pre-approval amount. And some places have higher taxes than others. And so
Mhm.
it helps when you know where you'd like to go in the beginning, but we can always figure that out along the way, right? And then lastly, about homeowners insurance. Homeowners insurance is the one that you will only find out after you're under contract, right? Because once you're under contract, now you will be under a contingency time period that you're able as a buyer to shop around for the proper homeowner's insurance that's within the value, the price range that you can for your particular pre-approval.
Yes, but we can also help you with that.
That's right.
Yes, we can direct you so that you can get a listing of home insurance companies.
That's right.
And get quotes from each of them. And there's always one that will suit you.
That's right.
And suit your budget.
And that's what we do. We make sure that all the pieces to the puzzle are coming together for you as they should. So, Rod, to kind of wrap up this portion of the conversation today, what would you advise buyers as a lender that they should do, knowing this information now, to maintain within their debt to income ratio when looking for a home? What's your short phrase for them to remember? What should the buyer do to maintain their debt to income ratio,
Do
knowing this
not acquire any new debt. Number one, do not let anybody run your credit scores while you're shopping. Don't let anyone run your credit scores. Do not you keep your credit card usage to a minimum. Just pay the very minimal things that you have to pay for. And like I said, don't let anyone run your debt. You have what they call principal, interest, taxes, and insurance. That's what they call PITI, which is what we've been talking about earlier. Now, the condo association is not part of that. But so a lot of people shopping for houses, they don't really account for that. So that's where it's really important to have someone like Kim and her mother to be able to assist you with that, to make sure that, hey, when you look at that condo or something like that, where you're paying that additional monies, you're still not over your pre-approval amount. So it's very important to keep your budget to a minimum and to make sure that you're communicating with your real estate agent and your loan officer as you're going through your process of looking for a home.
That's
Excellent,
right.
excellent information.
Yes, yes. Well, let's jump in. How you're going to compare all three of the most common loan types for the greater St. Louis metropolitan area and St. Charles area and some of the surrounding cities is beyond me.
Yes.
But you're going to do it, Rod.
Yes. We're going to talk about FHA. Rod has already mentioned briefly conventional and the VA loans. And so Rod is going to break this all down for us
with 10 different factors. Rod has his notes and he's ready to go. And I know, Rod, you're going to say, okay, these are the definitions. Define them first, right? Give them the guidelines. Tell them what's the credit score for each, down payment for each. I'm just going to run through the list that you're going to hit, right? The mortgage insurance for each.
Inspections.
Yes.
Appraisals.
Okay,
home
sure.
price limits, debt to income, which we talked about, and it doesn't hurt to talk about it some more.
That's right. And then the pros and cons of each. Yes. And then at the end, we'll give you a little bit about USDA loans as well. So take it away, Rod.
Wait a minute,
Thank you very much, ladies.
Take a deep breath.
Yes, take a deep breath. Talk slowly and clearly as you are so that they can really take this in. Because I know we all know about these loan types.
But wait a minute, one more interruption. Get out your pad and pen.
Yes, very important.
Yes.
And Kimberly?
Always make sure you screenshot or screen record in this case, right? To make sure that you're getting this information for later. But if not, you can watch us on replay. All right, Rod.
Thank you, ladies. So FHA, let's start with that. FHA is a government-backed loan. So what that means is that the government guarantees that loan if for whatever reason you get foreclosed on, the government's going to back the lender up so that they don't lose all their money on that process. The guidelines for an FHA loan are a bit easier compared to a conventional loan. They have a little bit higher, what they call debt to income ratios, like we mentioned before. You can go as high as 50%. In some cases, maybe even a little higher, just depending upon the lender. Also, your credit requirements are a lot easier on an FHA loan. Conventional loans are going to be private loans that are backed by the banks and private lenders. Their criteria is going to be a little bit stricter compared to FHA. They're debt to income ratios are going to be lower also. So with a conventional loan, you're looking at around 33% on the front end ratio, about 43% on the back end ratio. Again, depending on the lender, sometimes you can go a little bit higher than that, but really try to stay within those parameters to get you the best rates and the best approvals. Like I said, you can go over that a little bit. On the VA loan is also backed by the government. Now, not everyone can get a VA loan. You have to be a veteran that's got a certificate of eligibility, which means you have to have an honorable discharge or better to be able to get a VA loan. A VA loan is 100% financing. The other two loans have different financing down payment requirements. FHA, you're looking at 3.5% minimal requirement for FHA loan. So that's how much money you have to have in your pocket. So let's give you a round number. If you're buying a house that's $100,000, your down payment minimal requirement by FHA is $3,500. That's what you have to have into that game right there. If you're looking at conventional, then you're looking at 3% down, which is the lowest you can go if you're a first-time home buyer or have not owned a home in the last 3 years, or you can go up to 5% down. Via conventional can go lower than that also, or higher than that, excuse me, also just depending on you, but those are your two lowest. You can go 3% and 5%, but again, those normally apply to first-time home buyers. Your VA loan is 100% financing, so that means you have no down payment at all required on that. And again, you have to be an honorable discharge veteran in order to acquire that type of loan.
Keep going, keep going. We're just joining you on the screen. Yes, yes, excellent, excellent
As for
information to
the
know. Yes.
as for the credit score requirements, your credit score requirements, FHA, you can go, again, it depends on the lender, but about 580 credit score is about the average that I was seeing that you can use on FHA. In some cases, you may be able to go down to a 560 or a 550, but really that 580 is really about that sweet spot there on up. So you can be 800 credit score and go FHA. So, but anything from say 550, 560 on up, you're good there. Conventional, you're looking around a 640. You want to be a 640 and up on the conventional score, and that's going to be able to get you approval as long as you stay within the debt to income ratio guidelines and you have no lates in your mortgage. Same thing with FHA. Now, FHA will allow you to have one or two lates or one late in the last 12 months on a revolving or installment debt. But again, you want to make sure you're as clean as possible, regardless of which loan that you apply for. VA has a lot of the same criteria as FHA because they're both HUD-backed loans, so they're going to meet a lot of the same criteria as your as the FHA loan will. In regards to the mortgage insurance applies to all FHA loans. So regardless of which loan you have with FHA, you're going to have a mortgage insurance. Now, I just remember there was one FHA loan where if you put a substantial amount down, you can have a much lower MI, but you're looking around about 15% down or higher. So that would be
Let
going
me,
with. Mhm.
I'll interject. I'm sorry, but MI is mortgage insurance.
Yes,
So,
yes.
mortgage insurance
Yeah,
MI. Yes, I know
yes,
you're in your
yes,
lender mode. I know that's right. But
yes.
yes, mortgage insurance and for me, I'm wanting to go back and replay this and make sure because we educate ourselves as realtors on all aspects of the transaction and make sure that we are able to send our clients to the experts in their respective field. I want to go back and take notes. So just go a little bit slower for me
Okay.
so our viewers can make sure they can take notes too. So yes, you were talking about mortgage insurance, FHA loan.
Yes.
But
So
I have
FHA
a
loans, like I
question.
said, they have what they call upfront
You
mortgage
have a question?
insurance.
I'm sorry. No,
Yes.
go
You
ahead. But when you get a breather, I want to have a
What is your
question.
question?
Okay, go ahead. Go ahead.
Okay. Okay. You said the mortgage insurance. Okay, so that's added to your mortgage each month.
Yes, your mortgage insurance is a payment that protects the lender. Again, goes back into if that property gets foreclosed on. So it makes sure that the lender can get reimbursed on part of their funds, but the buyer has to pay for that.
Okay.
FHA, you have that normally throughout your entire loan. Conventional, you will have it up until you get to 79.99% of your debt to income rate, or excuse me, of your loan to value, my bad. So if your loan to value is, let's say 85% on a conventional loan, well, once that property either appraises out higher to where you're at 79.99%, or you've applied enough principal or enough to the principal to get it dropped down to that amount, you can actually eliminate your mortgage insurance that way also. So that's one
Okay.
good thing about a conventional loan. You can actually eliminate that after a short period of time of owning the house.
But
VA,
you say with the FHA, it's for the duration of the loan.
Yes, yes. In most cases, yes, it
Oh,
is.
What if you put a 10% down payment from the beginning with your FHA loan?
It will lower your payment, your monthly payment, but it will not
okay,
eliminate it. Now, if you put again, I've got to I apologize, I did not have this off the top of my head, but I believe it's 15 to 20% down on the FHA. You can have a much lower payment to or pretty come close to pretty much eliminating it, but it won't be nowhere near as bad as just putting the 3.5% down. That's going to be a
There you
much
go.
higher payment.
okay,
There you go.
okay.
Keep going. Thank you, Rob. We know our viewers would have those questions. So, a lot of this excuse me, information, I'm just getting my voice back.
It's okay.
Deal with
Okay.
it. A lot of the
You've been
information we
singing too much,
have,
folks.
but we want to be sure that you get it as well. So keep going, Rod.
No problem.
Mortgage insurance.
Yes. So again, I think I've already covered conventional and FHA. VA, depending on the type of VA, if you're a disabled veteran, then you can eliminate your mortgage insurance. Otherwise, you would have mortgage insurance as a VA loan also, and that is a loan, like I said earlier, is 100% backed, or excuse me, 100% financed, financing. So you have no down payment requirement on that one at all. Any other questions about MI?
I think you covered it really, really well. Keep
Wait, I
on
forgot one
going.
thing. There's on FHA, you do have an upfront in mind that you're financing into the loan if you do not wish to pay for it upfront yourself. You can finance that into it, but then you still have a monthly payment. So with FHA, you have two different types of mortgage insurance. You have upfront mortgage insurance, and then you have the monthly mortgage insurance. So I do want to make sure people understand that also. And we do calculate that into your debt to income ratios when you come to us to qualify for the house.
That's right. That's right. So, Rod, tell them about how inspections are different depending on the type of loan, whether it's FHA, VA, or conventional.
Yes. So therefore, each home has to be appraised for us to determine the value of that property to make sure that whatever that seller's asking for in that value, it meets that. And we go to a third party company that goes out to ascertain that value. They will then, if you go conventional, you have quite a bit more leeway in regards to the condition of the property. If the property, let's say, is not totally, updated or maintained or whatever, you can sell that property what they call as is, which means the seller will not pay for any sort of repairs on that property. FHA, on the other hand, or VA, both of those are a bit stricter on their appraisal requirements. They want to make sure that the property has very little issues in regards to the condition of the property. The FHA doesn't want cracks on the on the concrete, or the foundation or anything. They
Or
want to make
chips
sure
in the paint. They don't
exactly
want chips
in
in
the
the
paint,
paint. They don't want
broken
cracks.
windows,
I mean,
anything
it's a
like
good
that.
thing
Yes.
to an extent, right?
Yeah, well, they want to make sure you have a sound house, which is a good thing.
That's
Because
right.
they're bagging it, the government's bagging it. So when they want to make sure that whoever's buying that house is not putting a bunch of money into it initially right after they bought it. So that's
That's
one
right.
benefit of FHA. Where the conventional side, if I got a house that I haven't really done much to for 20 years, and if somebody wants to buy it, they're more than welcome to do it.
And that's usually for maybe an investor who
Exactly.
who 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 wants to buy a house as is, that's
Mhm.
not in
Mhm,
good condition.
mhm.
When you're
Yeah.
working with us, we're making sure that that home is not in a flood zone, that the
Mhm.
seller's disclosure is checked also before we step foot in the home, so that we know it's a sound home. It doesn't have foundation issues, mold, a faulty roof,
Yeah.
HVAC is not historical, right? We're making sure that those things are upfront. But when you have the FHA or VA loan, it goes even further. Chip paint and things that Roger was talking about, and a
Mhm,
lot of the things that we would request anyway to be repaired, that's on that checklist for FHA and VA.
mhm.
So it's not so, crazy as people may
No,
think.
it's for your protection. But
Yes.
just remember, when you're looking, you cannot buy as is, even though the price may be tempting, but you won't get a mortgage for it.
Not with an FHA or
No,
No,
VA.
yeah.
no,
With
no.
your
With conventional, you
conventional,
can.
Or
Yes,
cash.
yes,
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 conventional or
Or
cash,
cash.
then
yes.
Yeah.
you can go ahead and buy that as
It
is
is
property.
and
Because as is again means that the seller is not going to do any repairs,
yeah.
and
Mhm.
FHA and VA require the repairs, right? So
Exactly.
keep going, Roger. This is excellent. Talk about appraisals.
Okay, so again, with the appraisals, each whichever type of loan you go with, if you go with the conventional loan, as I mentioned earlier, you don't have to have the home in tip-top condition. You can have some issues with the property, and long as that value still comes in, which is what we're looking for as the lender, then we're going to still go ahead and move forward and close on that loan. If it's an FHA loan where you've got issues with it, then before we ever cross that finish line, we're going to have to go back, or you're going to have to go back with the Turner team and negotiate that with the sellers on whether or not they're going to repair that, or if you need to walk away from that property. But again, that's a discussion that's going to go between you and the sellers and the Turner team to make sure that that's negotiated properly. To me, FHA is always a loan that if you've never owned a house and everything, and you're not familiar with how to maintain a home, I think in a lot of ways that's a better way to go, in my opinion. But again, that's just my opinion. But you don't want somebody that you want to buy a house where you got to put in a bunch of money right from the bat. And that's what at least for first time home buyers, I think you should really try your best not to walk into a situation like that. The appraisal on the VA side is going to be the same way, basically, in regards to the criteria that the FHA was going to want to meet. They're going to want to make sure that their property is in good condition before they'll go ahead and fund that property. But other than that, that's really your differences between the three different law appraisals. The debt to income ratio, I think we already discussed that, didn't we?
Yes.
Yeah. Okay. The pros and cons of the different loans.
Before you go on,
It's
we
okay,
want to
Jay.
interject. We want to interject, Rod. So appraisals, that's important,
Very,
buyers,
very, very important.
because that's the value. If the appraisal is under the sale price, you'll only receive a loan for the appraisal value as opposed to the higher sale price. So that's why you want to make sure that the home that we put an offer on as a team here is one that would likely appraise for the value that you are going to purchase it. But if it does not, we have our
We have
strategies where
solutions. Yes.
solutions and strategies that we protect you.
And first is the appraisal writer. And that's very important because this will protect you if a house does not appraise. And then also,
Yes.
the appraisal,
We're able to
we're able
negotiate
to
it.
negotiate, and that's where your realtor's expertise comes in,
Very much
and
so.
we will negotiate with the sellers and come to agreeable
That's right.
solution.
And you
Yes.
have an attorney on your team and a business professional with her MBA. But most importantly, you have a mother and daughter team who cares about you like family. And we're going to make sure that you are protected through the entire process. So you don't have to worry about if the home doesn't appraise, will I have to come out of pocket? Will I have to pay this difference, this appraisal gap? No, you will not. You have the option to do so if you choose. But we have been so successful with God's favor to be able to negotiate down to that appraisal value. But when FHA comes in to do the appraisal and when VA comes in to do the appraisal, they are going to be looking for their checklist of inspections. And if they find that there are things that are not suitable to FHA and VA guidelines that the seller has not yet done, then they will require those items be complete in order for the home to appraise at value. Isn't that right, Rod?
Yes.
100% correct on that.
Yes.
Okay,
Yes.
I get those
okay.
all the time, and they have to resolve them. And a lot of times, most people do, and we end up crossing that finish line.
Yeah, and one time, remember Kimberly when we went out to help get the paint chips removed from the shed in the backyard,
That's right.
and I was like, my goodness, they went down to the paint chips on the shed.
That's all
And
right.
so,
Well, we were out there with our client making sure that things were done right. That was on when we were on the sell side because, of course, we
yeah,
work with sellers and with
and
buyers
buyers.
and investors. So,
Mhm.
excellent, excellent. I think, Rod, you were getting ready to just sum up this extensive list of comparisons here with some pros and cons for
Yes.
FHA, VA, and conventional loans.
Okay, so thank you again, ladies. Let's start with the VA. VA is 100% financing. So that's always great because you have very little money out of your pocket. But again, as also mentioned too, that you have to meet a certain criteria in order for you to go VA. Not everybody can do that. You have to be honorably discharged to be able to go VA. So that's going to meet the smaller fraction of the people that are out there shopping. Now, for the bulk of people out there shopping, as I mentioned earlier, FHA has easier requirements for you to qualify. So if you got a little blemishes on the credit, say in the last 3-4 years, then you might want to go look at FHA route to get the financing done. If you've been excellent credit, no issues on your credit at all in the last 3 to 5 years, and just spotless, then conventional is your route to go. As I mentioned also that the the appraisals on how they're going to ascertain the value on there, and also just the condition of the property. FHA, VA is going to always be better. Conventional, you can have a property that's not in the best of conditions and still sell it, and again, we will still fund on it in most cases. Uh, the guidelines on the conventional side are a bit stricter, as I mentioned earlier. So you want to come in as clean as you can on the conventional side. The cleaner you are, the better you are. FHA and VA, you don't have to be as spotless on the credit. You don't have to have the highest credit scores to qualify. And bottom line is, if you're not sure, the best thing to do is to call the Turner team and have them contact have you contact me or another loan officer to get you pre-qualified. Preferably, you're going to call me though. And we will make sure that you qualify for whatever program that's out there for you. That's our job, to make sure you fit a particular program, and we can get you across that finish line, whether it be now or 6 months down the road or even a year down the road.
Yes,
That's
yes,
right.
that's so true. And we've had those situations too where sometimes you just have to wait a couple of months and get everything in order, and then you go back out there and you find your home.
That's right. And we help you prepare. So
Yes.
no worries over
Mhm.
here. If you need to prepare to buy your home, we start with you even 1 year out with
Mhm.
our free consultants who will make sure that your credit is in order, that you have the savings that's needed, your debt to income ratio that you know so much about now, right, is where it needs to be, so that we can send you to Rod, right? And Rod can go ahead and get you pre approved. So excellent. We're excited
I
for
would like to say one
you
last thing.
and your future.
Communication is very,
Yes.
very, very important. That the client communicates with both the realtor and with me as the loan officer. Lack of
Yes.
communication, I've seen that destroy a lot of deals because
Yes.
the buyers weren't communicating properly to the agents or to the loan officer. So if you don't communicate the whole thing, because we don't, we're going to find out as a loan officer. I don't care what you're hiding, we're going to find that out. So
And
may
you
as well
know,
tell them.
we make sure our clients are upfront and honest,
Yes.
right? And so we don't have those problems because we make sure that we're doing business by the good book. We make sure that we have built that relationship with you already. And if you are a client online, you already know because you're family now, right? And so make sure, if you're thinking about it, you scan the QR code that's been on the screen, hit the link in the chat, and
Mhm.
schedule a time with us so that we can get you on the road to home ownership.
Mhm.
Of course.
Well, Rod, I just wanted to say that one of the things that we do tell our clients is that they're it's very important that they communicate with us and that we will communicate with the lenders, because we keep them mindful that the lender will do a credit check
Mhm.
right before closing.
Mhm.
And I've heard horror stories where people are 3 days out and their loan gets pulled because there is a review right up until closing. So
Mhm.
you can't say, well, last month I was good. No, you have to be good all the way
Exactly,
until
exactly.
it
until
has
it closed.
funded,
Yes,
closed and
and
Exactly.
funded.
funded.
Yes,
As
Okay.
yes,
as I
yes.
mentioned earlier about your revolving installment debt, that does not mean you stop making your payments because you're under contract on a house. You keep
That's right.
making your payments. You make your credit card payments, keep making your car payments, keep making your house payment or your rent payments. That does not
Yes.
mean, well, hey, I'm under contract, I'm ready to move out. No, you continue making that, because I've seen too many times, even recently, where a
Yes.
person under contract, we're getting ready to close, and like you said, we pulled that credit about 2 or 3 days before closing, and we see that you didn't make a payment on a bill, or you didn't make your rent payment or mortgage payment that month. I've seen people basically be homeless because they can't now buy that house now, and they
And
out of their lease.
we're so just happy and honored that that has not happened to
Yeah,
any of
well.
our clients, and it won't, because we make sure that you have crossed all those T's and dotted all those I's up
Mhm.
front, and
Mhm.
that we ask those questions even before we send you to
Yeah.
ride.
Yes.
We're making
Mhm.
sure you're prepared with our consultants.
And do not quit your day job.
Yes, and that you don't quit your day job, and that you don't switch from a full time to a part time
Time
or vice
job.
versa, and all the other things up front. We're all about empowerment and education, as you can see, to make sure that you are well aware of all the factors that could potentially, most important factors, I'll say,
Mhm.
that could potentially lead you array or a ride,
Uh-huh.
or
Uh-huh. A right.
most importantly, lead you towards, in the positive, right, lead you towards home
Hmm.
ownership. So
Right.
Yes.
thank you for the information,
Yes,
Rod. That
that's
was
awesome.
As
very
she mentioned, as your mom mentioned about the jobs, if you have a second job and we qualify you based off of that also, don't quit that either. Don't quit
Yes.
that's
any
right.
jobs. Just stay
Yes.
where you're at, until we get to that finish line and we'll be good. Everything will be fine.
Yes, yes.
Yes, excellent information, Rod. Well, many people sometimes put off buying a home, even though they have dreams of owning a home. But we want to let them know that everything is possible.
That's right.
Now, one of the things I like for you to tell our viewers is about down payment programs,
Sure.
because that's one of the big obstacles that people see when they're dreaming about buying a home, thinking that they have to save up, thousands and thousands of dollars. But
Yeah.
you're here to share the good news.
Yes.
So please let us know what it is.
Yes, so no problem. Thank you again. So there are programs out there that will allow people to these are first-time home buyers or people that not owned a home for the last 3 years. So you can own a home prior to that, but it has to be at least a 3-year gap in between that last time you purchased a home. But basically, what it is, you have programs like Beyond Housing, MHDC. A lot of your municipalities will have programs available to you. I believe Florissant, I've got to check this year, but I believe last year they had from $5,000 to $6,000 available for first-time home buyers. I believe St. Charles County, the entire county, I believe, can go up to was it 5,000, 6,000? O'Fallon can go up to 10,000. So each area can be different. So it's very important that you call your municipality that you're inquiring on, or you think about moving into, and see what they have available to them. I will check personally myself to see what we have available or what's out there in the community that we can use also for the down payment assistance. Some of those programs that are out there, they are what they call grants, which means you don't have to pay them back. But then there are also a lot of programs out there that are grants that you do have to pay back. For example, MHDC, Beyond Housing, are the programs where you may have to pay them back over a 5 to 10 year period of time frame, and that will affect your debt to income ratio too. Though, but we'll worry about that later when you come to talk to us. But those are things that can assist you with getting the monies for your down payment. You don't have to have all the money yourself, but if you are wanting to use a down payment assistance program, make sure you inform your loan officer, me, or whoever you're going to use, preferably me, that you're going
Yes,
to be
that's
going that
right.
route, because that can affect your underwriting approval. So, and what I mean by that is sometimes when you don't have any skin in the game, your underwriting approval is going to get a little bit tighter, because they would prefer that you have some skin in the game. But if you don't, we can still get you approved. But make sure you come to us and we get you approved ahead of time first before you go shopping.
So, Rod, do they need to have money in the bank?
It's good. It was always good to have money in the bank when you're buying a house. That's your
Of
biggest transaction
course.
you want to make. And so if you're
But
broke,
how much? How much?
we don't want you to get foreclosed on. Our whole goal is to make sure that when we put you into a home, that you're what they call a ready, willing, and able buyer. And so
Yes.
being a ready, willing, and able buyer means you've got funds that you can access if you need to. If you don't have any money in the bank, it's very hard to get you approved to get you the financing. You can get a house with little money out of your pocket, but we still want to make sure that you can make that payment as soon as that first month payment comes up.
Yes.
We never know what's
Yes.
going to happen with life. So me personally, I don't. I would prefer that you had some money in the bank even after we close on the house. I don't want you to be broke, because I want you to make sure that you're living comfortable. And if
Yes. Well,
living paycheck to paycheck, that can hurt you, pretty bad if something happens. So we don't want that to happen.
that's right. That's right. And it's always wise to have 3 to 6 months
Yes.
of
Of reserves.
reserves,
That's right.
Very, very much.
especially in today's market.
Mhm.
So we don't want you to buy a house and then can't afford to pay the mortgage. So if something was to happen, so it's always wise to be financially secure in that respect.
Right.
Very
And
much.
more specifically, having at least $2,000 to $3,000 is what the Turner team always ask of our clients to have in their bank account. Even though maybe with these programs that we're talking about now and those that we're going to get to, you may just have to bring $1,000 ish, right? Around $1,000 to the closing table to cover those prepaid, right, expenses under the closing cost category.
Yes. Well, also, Kimberly, the buyer is going to need money for home inspections.
That's right.
Mhm.
That's
Yeah.
not free, and they could be, depending on how many inspections.
It runs around 800, right?
Yes.
800 a la carte for the total, because we
Hmm.
always like you to get at least 4 inspections, right? And so those 4 inspections, they are usually a la carte with the inspectors that we normally work with, who do a great job and we trust for our clients to make sure the home is sound and secure. So you want to have that. That's within 7 days of being under contract. You
Yeah.
also will pay for your appraisal, which runs around 450 to 550,
About
depending on
500 to 650.
Oh
depending
my,
on the
yes,
They've
lender,
gone
is
up.
what
They've
I was
gone up.
getting to,
yes,
right? So
yes.
Guild Mortgage is from 500ish to 600ish. Others could be 450, right, to
Well, we don't
500.
control that. It's the third party that we're not the appraisal company. So we go through a
That's
company
right.
that actually orders it themselves. So it's going to be kind of fairly generic by your
You
area.
subcontract
Yes,
out.
Yeah.
You
yes.
subcontract
So,
out.
and
And
it
we
pretty
know
runs.
that it runs
Yeah.
from 450 to
Uh,
650. You can
Yeah.
think in that
Right.
range depending on the
mhm,
lender, because of our past times, right? But
Exactly.
nonetheless, you want to make sure that you have those monies available and your earnest money up front, which
Exactly.
you
And
can
one quick
assume is
thing, if you
going to
don't mind
be
me.
at least 1%
mhm.
of the sale price is your earnest money amount. So
Yes.
those are the three costs out of pocket. And the
Kim, one
earnest
thing real quick,
money,
if you don't mind me interjecting real quick.
yeah, go
Like, you
ahead.
Go
brought up
right
something that
ahead.
was very, very important in regards to the down payment assistance. If you're not using your own funds for down payment, it is extremely important that you have at least 1 to 3 months reserves, meaning by the month, the mortgage payment. So if you've got a, say, $1,500 a month mortgage payment and you're not using your own money for down payment, you're using, say, MHDC or whatever program that may be available. When we run the findings, the automated findings want to see that you've got at least 1 month to 3 months of that house payment in the bank or in a 401k or somewhere where it's in, and you have access to it. So that's very, very important. So if you don't want to use all your money for the down payment, great, but keep it in the bank still, but we still want to use that for your reserve so that it helps you to qualify for the approval.
That's right. That's right. And that's the question that my mother was getting to get you to say, right? So
Mhm.
that you can know what you have to have in the bank in order to be able to buy a home. Most definitely. So talk a little bit about, with down payment, closing costs, right? Closing costs. Explain what that is to our viewers, Rod.
Sure. Yeah, yeah. Your closing costs are going to be like your appraisal, your title fees, all your title fees. You're going to have, all your third party fees that are involved with that. If you have, uh, um, you get the inspections, like you mentioned. Now, the inspections is something that's in some cases we don't require, depending on again the loan. Now, we will require appraisal on all of our loans, but like a home inspection, that's something that we don't necessarily require on all our loans. But you still want to make sure you have that covered as a home buyer. You want to make sure there's no hidden problems with that property. The closing costs will cover your let's see what it says. Your title fees. It will cover your per diem, your taxes, your insurance. Which what I call prepays. I think we talked about that earlier. You have what they call your closing costs, then you have your prepays. Your closing costs are what they call non-recurring fees. So those are fees that don't repeat. Your prepays are going to be your recurring fees, your taxes, your insurance, your mortgage insurance, your per diem, your interest until you make your first payment. Uh, when you have closing costs, the seller can pay certain fees, or even the lender can pay certain fees on that. The only thing they cannot pay would be your prepaid, which are the recurring fees, the taxes, your homeowners insurance, and your mortgage insurance, and your per diem. So other than that, the third party company, or excuse me, the seller can pay for that, or the lender, if you get lender credits, we can pay those other fees for you.
Excellent, excellent. I think it's
Oh.
really important to talk about.
Mhm.
Yes.
No, I was just wondering. We had a client one time that she received money from a family friend.
Yes, gift.
Um, how does that work
Talk
out?
about the gift and
Yeah.
the sourcing of the
Hmm.
gift money.
Yes, yes. Thank you very much. Okay, so um, each loan program that you use has a gift allowable requirement. Conventional will allow you to go up to 3% on a gift, and it can be from a friend or family member. And what I mean by gift is that you're not paying that back; they're just giving you that money to you to apply towards the purchase of a house. It's up to 3%. We have to source those funds, so whoever's giving it to you, we have to see last 30 days bank statements showing that those funds were in the account. Excuse me, depending on how they're going to disperse it, if they're going to do it the day of closing, They can sometimes have it wired to the title company at the day of closing, and that normally can suffice as long as they've got the 30-day bank statement showing that the money was there. FHA can go up to 6% seller, or excuse me, 6% gifts. I was getting mixed up. 6% gift. So let's say $100,000 house, you can go up to $6,000. On a conventional, on a $100,000 house, you can go to $3,000 in that gift.
Mm.
Same thing applies with VA. You can go up to 6% on the gift on that one also. Again, it can be a friend or a family member that will apply that gift, and as long as we can source it, we can
Can be
use
a
it.
friend.
That it can be a family member who can apply the gift, right?
Yeah, or
Did you
friend. It can be a friend too
or
now. They've
friend?
changed it. They've loosened up the
Okay.
guidelines a bit. But we're going to
Oh,
provide you with
great.
a letter saying this is a gift. And it's coming from Uncle John, and Uncle John's got $8,000 in the bank, and he's going to give you 3,000 of that. And he shows us a bank statement, and we see that, and we give him the gift letter, and he signs that to say that, hey, this is not a loan. We're moving forward.
Oh, excellent.
Yes,
Excellent.
yes. And I want to just go to two things before we get to what you have up your sleeve, right? So talking about down payment, and you went through the down payment programs, just to kind of go back a little bit here.
Sure.
Summarizing that for you as a buyer, we talked about earlier on when we were comparing FHA conventional and VA, that FHA general down payment amount is 3.5% down, that conventional general down payment amount is 5% down,
Mhm.
that VA, thank you to our veterans,
Is zero.
0% down, right? But when you are a first time home buyer, again, like Rod said, that means that you are buying your home for the first time, or you have not owned a home in the last 3 years.
Mhm.
Now you may qualify, granted, all other factors are suitable, for down payment assistance. And that MHDC loan, I want to just talk about that one particular. There's
Mhm.
others that Rod mentioned as well within the municipality, but MHDC, it doesn't, it's not determined by municipality, right?
You
And
can be
so
anywhere.
It
that
can be
one,
anywhere.
you
Mhm.
simply have a 0.5% fee that you pay, 0.5% of the sale price that you pay. So you can consider that to be your down payment, even though it's considered a fee and you actually have no down payment with the funds from MHDC. But to make it simple, 0.5% down payment of the sale price. That's it as a first time home buyer. So no longer is it the 3.5 or the 5%. You just had that 0.5% for FHA
Mhm.
or for conventional loans. So that is something to really be, knowledgeable about when you're thinking about how much money do I need to have saved. Yes, that $2,000 to $3,000 for safety purposes. Also, potentially to go towards closing costs, depending on if you're able to get what's up our sleeve coming up here, right? Or not, based upon your finances in the home.
Mhm.
The
Mhm.
last thing I wanted to mention was talk a little bit, not much, but just a little bit. Give them a taste of USDA loans. We were moving forward fast there. We want to just talk a little bit about
That's
that
no
for
problem at
our
all.
rural buyers.
Okay, so USDA loan is another loan that's backed by HUD, and it's 100% financing. So I said that there were two different types of loans that you can get 100% financing. VA is one, and the other one is USDA. USDA loan is a rural loan, so you cannot be, let's say, in the city of St. Louis and use a USD loan. You have to be out in a rural area. So if you're out, maybe out in Troy, or even out like Wright City, even parts of Wentzville and St. Charles County, you can use it. But again, we have to make sure it fits within that USDA region mapping. If you do, then you can actually get 100% financing, and the guidelines on the USDA loan are very similar to the FHA guidelines also. So they are going to be a little stricter on that appraisal, making sure the house is a little bit sounder. And what else on that one? It makes it a lot easier for people that are tight on funds and don't have the down payment, and they want to live out in a rural area. They can still get a house and not have to worry about a large down payment, and get a house that's in pretty good condition too if they do USDA, because like I said, the appraisal requirement is going to be a little bit tighter.
Excellent,
Yes,
excellent.
yes.
Now, Rod, can you tell me about the down payment and the perfect combination,
That's right.
down payment and closing costs? Is there any such animal where you can get both?
Well, you can get the down payment. You, as I said, we can get with MHDC or some of the municipalities that offer down payment assistance programs. There's just so many out there, and then they come and go too. So MHDC is one of the few that are consistent. We have a program called Gateway, and that
Oh,
That's
program,
what
yeah,
we're
that's
getting
up
to.
to Steve there. That's right
Yes,
up at
that's
Steve
the
there. We never
animal.
get out there. So if you live in a certain zip code within the St. Louis metropolitan area, you qualify. We will give you a $6,000 grant. Okay, which means you don't pay it back.
Ooh,
This is money we're going to give you. So if you live within a zip code area, we're going to pull it up by your address. If you either live there or you're going to be moving in one of those areas, those are the only two ways you can get it. And we don't care how much income you make. A lot of your down payment assistance programs are going to be income driven, where you got so much income, you got to make sure you fit within that criteria. Well, with a Gateway program, you can make $1 million, and if you live in that zip code area, we'll still give you that $6,000, and it can be applied to both FHA and conventional. So either
oh,
one of them you can
excellent.
use it for. Okay. So it will allow you to use it towards your closing cost only. You cannot use it towards your down payment. So what I can do, I say we want to go with MHDC on your down payment. Well, MHDC is going to cover your 3.5% or your 3% if you go conventional and get that. Now, if you do 5%, you're going to have a little bit of money out of your pocket, but it's still going to cover the bulk. Then we come and use my Gateway program for your closing cost. So yes, there's a very good chance you can actually buy a house, FHA or conventional, with very little or no money out of your pocket with those two programs combined.
Well, that just sounds like Christmas in a
yes,
box.
yes, yes. We
So wait
love
a
that.
minute. Yes. So please share this information because we want you to be a home owner.
That's right.
That is our mission, to get as many people in these communities to stop renting. I understand
Mhm.
some people have to rent, but in order to accumulate wealth, you need to buy a house
That's
that
right.
also maintains your budget, because rents in this day and age with inflation, rents keep going up and up, and the landlord has the prerogative to increase your rent when you renew your lease. Now, when
Mhm.
you have a home and you have a mortgage, it's a steady rate that you pay each month. It won't go up because of inflation. You have 15 years, it's going to be the same mortgage payment for 15 years. If it's 30 years, it's going to be the same mortgage payment for 30 years. And
Mhm.
then you build up equity. So there's so many good reasons for you to go out and to get on the right track. If you're ready, call us because we're ready to take you and to see the homes that are out there. And there are plenty of beautiful homes out there. And then we have excellent lenders like Rod
That's right. And
with
we'll
good,
One more.
connect
and we
you.
will
Mhm.
We
connect
will
you.
connect you with Rod. That's
I got one
right.
more trick up my sleeve, real quick.
Uh-oh.
Uh
Let's
oh,
go
go
One
ahead.
ahead,
more.
Oh,
Rod.
oh,
It's called the
pull
three
the
two one
rabbit out the hat.
program.
Rod, pull the rabbit out the hat.
It's called the 321 program, and that's a conventional program.
Yes.
Anyone can use that as long as you apply for a conventional loan. You apply for their program and you get approval. It is basically it's $3,000 down, or excuse me, $3,000, 3% down, and
Yes.
you get a $2,000 gift certificate to Home Depot. And on top of that, we can give you up to 2,500 in lender credits towards your closing costs.
Mm,
So
that's good.
now that portion of it is a little bit income driven on the on what we give you towards the closing costs, but it's up to 2,500 down to $1,000 at the very minimal. Best part is only 3% down though. And that's the best part on the conventional loan.
That's beautiful.
That's
That is
excellent.
excellent because now we're telling you the recipe for success, right?
Mhm.
So you can get your down payment program as a first time home buyer with Guild Mortgage own Roderick Nash, right? And you're able to just maybe only pay 0.5%. That's right, less than 1% down for your down payment.
Mm,
Then we move over to our closing costs because if you've been watching us, you pay down payment and closing costs at the closing table. So now you have your down payment almost fully covered and your closing costs
yes.
able to get up to $6,000
Mhm,
depending on the home in closing costs.
mhm.
And thirdly, now we have given the I don't want to I was going to use a terminology, but no, we're giving the cherry on top, right? The
Yeah.
cherry on top is a
The,
good
the
thing.
three,
There we
two,
go.
one.
3, 2, 1. been able to buy down your interest rate with those credits. And now tell them how much lower can their interest rate become with that 321, and explain it just a little
Well,
bit more for our viewers.
well, again, the 321 is different. There's two different 321s. The one you want is the 321 buy down. This is actually a 321 program that we offer that allows
Oh,
you
tell
to
us
get.
about that one, Rod.
Yeah, yeah. So
Tell us.
that the 321, the program I mentioned, is actually a little bit different than the 321 buy down for the rate. The 321 program we have is only a guild program like the Gateway, where we'll do the 6,000. But with the 321 program, we'll give you 3% down. So you only have to put 3% down on a conventional loan instead of 5% or more. You will get a $2,000 gift certificate to Home Depot. So if you need to buy that appliance or whatever, well, that's going to help you do that. Or whatever you want, whatever you need for that $2,000 is going to help you cover that cost for that. And then the third thing you get with that program, which is the 321, is you're going to get up to 2,500 in closing costs that the lender will pay down to $1,000. Now that is a little income driven on that portion of it, but the rest isn't. And we can use that anywhere. Where the other one is limited to the zip code,
Yes.
the 321 you can use it anywhere.
So who can use that?
Anybody, as long as they apply for a conventional loan and get an approval.
As long as they're conventional loan purchaser, doesn't matter if you're a first time home buyer or not.
Oh no, no, first time home buyer, yes.
Okay, that's it. Yes, first
How about
time
that
home
Okay,
one?
buyer.
keyword. Okay.
Awesome, awesome. Now,
Okay.
now, do you also offer the 321 buy down program?
Yes, yes, we do.
Okay, so
I'm
talk a
glad
little
you
bit
brought
about
up
that.
that
Oh, we got four
321.
things here. Oh my goodness. Let's go, Raj.
You mentioned about what kind of rate buy down can you get. I just to give an
Yeah.
example, I used that Gateway program on a recent client actually, and was able to get their rate down substantially. Now, not everybody's going to get the same outcome because it depends on the purchase price. Just there's a lot of factors that are involved, so each person is going to be different. But we were able to use portion of that $6,000 Gateway program to buy their interest rate down into the fives. So that's very very rare, especially right now because how high the rates are going now. But back then, when they first came to me and they got the house under contract, we were still able to keep them in that 5% range.
Oh,
Yes,
excellent, excellent.
yes, that's
And
awesome.
um, some people they are like, "Oh my gosh, the rate is 5, 6%." Well, everything is relative because when we purchased our home, the rates were so much higher,
Mhm.
and you can always refinance
Mhm.
after 3 years or so.
That's
So
my third
don't let
ammunition.
that
That's
stop
my
you.
third one.
Okay, let's
Hey,
go. Let's go.
You
Let's
come to
gotta
me
go.
stay
for a
on top.
loan anytime within the 3 years after we close, or 2 years after we close, I will refinance it for free. So no guild fees when we come to you or
Oh,
when you come to us. So if within
That's
as we
right.
close on the house tomorrow, you have 2 years. If the rates drop, I'll call you up because I'll be keeping an eye on those rates for you. And I'll say,
mhm.
hey, guess what? The Turner team's looking out for you, and Rod Nash is looking out for you, and
Yes.
we can get you lower that rate down a point or half a point or whatever that may be, and we're not going to charge you for that.
That's
Oh, that's
right. That's
wonderful.
beautiful. Yes.
Rod, you have been amazing.
Such great information.
Yes,
And
yes.
believe you me, we keep in touch with our clients. Once you're our client, you're always our client. So we'll be looking out for you to make sure that if it's within the time frame Rod mentioned, that you are informed to go ahead and do that free refinance of your interest rate, which is
Yes.
really important for today's market, right? Like my mother said, interest rates are relatively really good compared to years previous. But if they happen to go back down, right, a little
Mhm.
bit lower, you'll be able to refinance. And
Mhm.
refinance simply means that you're
Structure.
restructuring your interest rate and potentially some terms, right,
Mhm.
Rod?
Yes, yes. Now I can
Okay.
keep your term. Let's say you've been in the house, 28 years, or sorry, 28, 2 years. So you got
Uh-huh.
28 years left on your mortgage. I can do a 28-year term so you're not adding those 2 years back. Or I can go
That's
Oh,
to a
right.
25
that's
year or
even
whatever you
better.
want to go on when we do the refi. So I can change those
Oh,
terms. It's up to you on what you feel most comfortable with.
oh,
You
that's even better.
That's
That's even
right.
better because a lot of people think that you have to start back
No, you
for
don't.
30 years, go back 30 years, and you lose those 2 years. Well,
Nope.
excellent,
That's right.
excellent,
So
excellent.
if you've learned nothing else, yes.
Well, wait a minute. Rod needs to take a break.
I know.
All
Woo,
of this
child.
information
Wipe your
has
forehead.
got me
I know. I'm like, whoa.
overwhelmed.
I realized my
That's
forehead was so
right.
big,
We're
man.
not
Yes.
overwhelmed at all, but we
No.
we hope that you're
Yeah.
not. And if this is a lot to take in at one time, just replay it.
Yes.
You'll listen and you'll be able to write it down and in videos, shot it, and all the good things. But listen, I know maybe you have some questions. Maybe you want to ask Rod some questions right now. If you do, we're going to take about 30 seconds here to let you type it in the chat, formulate your question, and we'll read it out to Rod. If not, and you have questions later, just feel free, give us a call, scan the QR code that's there on the top left of your screen, or click the link in the chat box, whether it's on replay or you're watching live, and we'll be sure to answer those questions and connect you to Roderick Nash, Senior Loan Officer with Guild Mortgage. Okay, so we are just so elated to have you on our show this evening, Rod. You have given such a
A
large
thorough.
amount of thorough,
Hmm.
informative, tips and
Facts.
strategies and facts and
Hmm.
just the ins and outs of the FHA, VA, conventional loan, as well as different factors that could affect your pre approval after you've been pre approved. And then we had some things up our sleeve here to talk about down payment programs, closing cost programs, 321 program that is specific to Guild Mortgage, and 321 buy downs.
Yes, that's
Woo!
quite a bit.
That was a lot.
No,
I'm
no wonder we had technical
I
difficulties getting
know.
on.
But God meant for it to get out. So
Yeah,
Yes.
we
yeah.
went ahead and God is good and we were able to get to the people. So that's the goal. Well, thank you so much. I think we may have a question here. Let's see what we have. Well, I'll just give a shout out to none other than Aaron Hinkle. Aaron says, great insight tonight. Thank you.
You're welcome. Thank
Thank
you.
you, Aaron. Thank you for being on. And I already kind of
Mhm.
showed this shout out here, but to Jackie, thank you, Jackie. Great info, she says. We
Mhm.
appreciate you and all the viewers who have come on tonight to learn about loan factors, types, and programs. We have enjoyed the conversation with our special
Yes.
guest.
Roderick Nash, Senior Loan Officer, not just the loan officer.
Yep.
He's
No,
a
Senior.
senior
loan
he is
officer.
That doesn't mean
senior.
I'm just old, okay? It doesn't mean I'm just
Ah!
Hey, that's what determines good wine.
Yes,
Okay.
yes.
But with Guild
That's right.
Mortgage,
That's
yes.
right. And we are going to be right here, same time, well, on time next time, because we won't have those technical
No,
difficulties. So
not
at
this time.
6 p.m. sharp tomorrow night. Tomorrow night is our next one and last one for the month of March. Of course, we do monthly webinars here with the Turner Team Realtors. And tomorrow night, 6 p.m., 7 p.m. Central Standard Time, we are going to be talking about building business credit. And we're extremely excited about this commercial webinar tomorrow. Of course, we do residential, as in today, and commercial each month. And our special guests are none other than Access Credit Repair and a legal enterprise with James Richardson, who was on our show previous this month, who broke down, being able to get yourself ready to get business credit, as well as creating your LLC. And he will be joined by Monica Medina, who's the owner of a legal enterprise. So we look forward to seeing you, same place, 6 o'clock p.m. Central Standard Time
Yes.
tomorrow on our Facebook page and YouTube page at Turner Team Realtors on Facebook and at the Turner Team Realtors on Facebook. Thank you again for coming out.
Yes.
Make sure you like, share, and subscribe, and we'll see you here again.
And
Thank you
thanks
all, folks,
again,
for
Rod.
coming. Thank you,
It was
her
awesome.
team. I love working with you guys. And guys, scan that QR code because I promise you, you're working with an awesome team here. Very good team here.
Yes.
Well, thank you so much.
Thank you. And Rod is fantastic. We can't
Yes.
wait to be able to connect you with him. All right. Well, take care, and we'll see you tomorrow night.
Be safe.
Bye.